Friday.
All right, well, let's kick things off right now and begin our market discussions with Jim Bianco, president at Bianco Research. And Jim, Vonnie mentioned the comments from Chris Waller, the Federal Reserve governor. And of course, he sounded a fairly dovish note. He was pretty dovish beforehand, but making his case for a July rate cut. That combined with the data that we did get, including the most recent consumer sentiment data from today indicating inflation expectations improving, does that put a July rate cut closer to a reality?
No, I don't think it does. I think it puts us closer to the reality that we're going to get Waller and maybe one or two other Federal Reserve officials to dissent. And he made his case as to why he wants to dissent at that meeting. And I'll point out that he said that, he was in favor of the rate cuts last year at this time. And it turned out that those weren't necessary either. So at least he realizes that, it's a guess. So I don't think we're going to get a rate cut in July. I don't even think we're going to get a rate cut in September. But we're probably going to see more dissents.
Jim, I want to ask you about the U.S. dollar, because as we see the president signing the Genius Act right now, we know that that's going to lead for demand for treasuries. The president talking about how, he wasn't going to let the dollar status slip, but we know the BBDXY is down nearly 10% so far this year, the DXY down 9%. It has been slipping. Is the thinking that the more demand for treasuries coming from perhaps, the expansion of the stablecoin universe, that's going to help in some way, the dollar, I mean?
I'm going to push back on that, and I don't think we're going to see the demand that they think we're going to see on treasuries. What you're going to get at best, first of all, let's talk about what is a stable coin. It's a money market fund without an interest rate. It trades at $1 like a money market fund. It's backed 1-for-1 by treasuries like a money market fund. But a stable coin does not pass through interest rates or a yield like a money market fund does. At best, you're going to see some people take money out of money market funds, put them into stable coins. That's not going to change the demand for dollars. That's not going to change the demand for treasuries. And what you have seen with the treasury market, I think as of late, since about May, is it recoupled, is that the dollar tends to strengthen when yields go up and it tends to weaken when yields go down. So if we do get into a period of continuing falling yields, I think you're going to continue to see the dollar weaken. If the yields go up, I think you'll continue to see it strengthen. That's the way it was before Liberation Day. It kind of lost that for a while, but I think it's back.
How are you thinking through tariffs and the new threats, the latest threats from the president, Jim, of 15 to 20% on EU goods, as well as the president's pronouncement that when he sends a letter, that's essentially a trade deal from where he sits? It looks like investors are kind of not writing it off, but looking past it for now until they see hard evidence that it's playing into their results, company results, or inflation data.
Yeah, I think that last part is right, in that what investors are doing right now is they're waiting to see signs of who is paying these tariffs. Now, we know from the Treasury Department that there is a big jump in customs collected or tariffs, and it's going to be to the tune of a couple of $100 billion this year. Well, somebody's paying that. Is it the exporter like the Chinese? Is it the importer like the company with its margins being squeezed? Or is it going to be the consumer with higher inflation? Right now, we don't see it really in any of those because it's too early. But I suspect that we're going to see it a lot more in the consumer side. We're going to see that those inflation numbers in the second half of the year are going to start to trend up, and that's when the market will react. But for right now, I think it's kind of, in a limbo trying to figure out where we're going to go with this, who's going to pay these, and how big they're going to be. And I might also add that if we remember after Liberation Day, it was the stock market decline that got Trump to give us a 90-day pause. Well, with new all-time highs, he's got no reason to back off. He's going to be very aggressive with these tariffs and with his tariff proposals until the markets give him a reason to back off on it, and so far they're not.
All right, good stuff. Jim Bianco, president at Bianco Research, kicking us off here as we count you down to the market close, about 30 minutes.